What happens when a property and casualty insurance company fails? It's a question many policyholders and industry watchers ask, especially when economic conditions get rocky or catastrophe losses pile up. Let's unpack how and why insurance companies fail, what happens next, and what it means for customers and the industry. First, a property and casualty insurance company typically fails when it can no longer meet its financial obligations, meaning it doesn't have enough capital or surplus to pay claims or operate its business. This could be due to several reasons: mispricing risk, under-reserving for losses, taking on too much exposure, poor investment decisions, or being hit by an unexpected surge in claims like a natural catastrophe or litigation event. Let's look at a few examples. Over the past 5 years, we've seen a string of insurer insolvencies, particularly in the Florida property market. Between 2021 and 2023, at least a dozen Florida-based homeowners insurance companies became insolvent. Some notable examples include FedNat Insurance Company and Avatar Property and Casualty. Many of these carriers were heavily exposed to hurricane risks and flood-prone areas. Combine that with escalating litigation, fraudulent roof claims, inflation-driven repair costs, and limited access to affordable reinsurance, and it created a perfect storm. But it's not just Florida. In 2021, California's Merced Property and Casualty was placed into liquidation following severe losses from the Camp Fire in 2018. Wildfires and tightening regulatory rate controls made it difficult for insurers to keep pace with rising loss trends, leaving them financially vulnerable. So what happens when an insurer fails? The process is overseen by state regulators. Insurance is regulated at the state level in the US. So when an insurer becomes financially impaired, it's the State Department of Insurance that steps in. The company may first be placed into rehabilitation, where the regulator tries to stabilize the business or sell parts of it. If that's not possible, the company is placed into liquidation. At this point, the state's Guarantee Association steps in. Guarantee associations are like safety nets for policyholders. They ensure that claims continue to be paid at least up to a certain limit when an insurer goes under. These associations are funded by assessments on solvent insurers doing business in the state. That means if your insurer fails, you're not left empty-handed, but there may be coverage caps, delays, or limitations in how your claim is handled going forward. So what could trigger future failures? There are several red flags to watch. One is escalating catastrophe losses, especially if climate-related events become more frequent and severe. Another is inflation. Rising costs for repairs, materials, and litigation could catch some insurers off guard if they haven't priced for it. A third risk is over-reliance on reinsurance. If reinsurers start pulling back capacity or significantly raising prices, it could stress small and regional carriers that depend on that support. We also can't ignore economic and financial market risks. Poor investment performance, mismanagement, or rapid growth without appropriate underwriting discipline can also tip insurers into trouble. And finally, regulatory constraints like limits on rate increases may hinder an insurer's ability to respond to changing market conditions, especially in high-risk regions like coastal Florida or wildfire-prone parts of California. So, while failures in P&C insurance are relatively rare compared to other industries, they do happen. And the reasons are often a mix of external pressures and internal missteps. That's why regulators, rating agencies, and reinsurers are all paying close attention to capital adequacy, risk exposure, and market dynamics as we head deeper into 2025. If you found this video helpful, don't forget to like, subscribe, and follow Insa Knowledge for more P&C insurance education, career tips, and industry insights made easy to understand.